Before you scroll, let me say this clearly. Market crashes don't happen when investors are afraid. They happen when investors feel comfortable. If you are investing in the US market right now, skipping the video could quietly become one of the most expensive mistakes you ever make. The 2008 crash wasn't just a financial crisis, it was a lesson. And today, the same behavior that caused it are showing up again. Stay with me till the end because the final lesson could save you millions over a lifetime. People didn't lose money in 2008 overnight. They lost it while retirement accounts felt safe, while home prices kept rising, while experts said this is a healthy market. That comfort is exactly what makes market dangerous. If you invest in stocks, ETFs or retirement accounts, tap like. What the 2008 crash really was. Most Americans remember 2008 as a sudden collapse, but the truth is the crash was built slowly. Low interest rates, easy credit, excessive confidence, rising assessed prices convinced people that risk no longer mattered. 401 grew, home equity exploded, and investors confused growth with safety. The most dangerous market is the one that feels normal. Comment below, does today's market feel normal to you? The fatal mistake investors made. The real damage in 2008 wasn't caused by the decline, it was caused by leverage. Mortgage debt, margin accounts, overextended balance sheets. When prices deploy, investors weren't give time to recover, they were focused out. Leverage doesn't just increase risk, it removes your margin for error. If you are using margin today, this part is for you. This time is different thinking. Before 2008, Americans said real estate never falls nationwide. Today, the story sounds different, but the mindset is identical. Technology has changed the economy. AI will justify valuations. The Fed won't allow a crash. Every generation believes it's smarter than the last one. Every bubble feels rational until it breaks. History doesn't repeat itself, investors do. Send this to one investor who believes this time is a different. Media expert and false reassurance. Before every major crash, the media sounds reassuring, strong fundamentals, temporary pullback, long term growth remains intact. They are not always wrong, they are just late. Markets don't collapse with headlines, they collapse quietly while confidence remains high. By the time fear shows up on TV, the opportunity to prepare is already gone. If you want preparation instead of panic, subscribe. The core lesson from 2008, the biggest lesson from 2008 isn't that the crashes happen. It's that crashes leave fingerprints, extreme optimization, retail participation spikes, valuation stretch reality, risk gets dismissed. Crashes only surprise investors who stop paying attention. If you are paying attention, comment aware. What smart US investors do today? I am not predicting a crash tomorrow. I am saying prepare like one is always possible. Respect downside risk, manage position sizes, maintain liquidity, separate emotion from decisions. The goal isn't beat the market, the goal is to stay in the game. If you have watched till now, you are serious, like and subscribe. The 2008 crash destroyed wealth, but it rewarded those who were prepared. Market don't punish ignorance immediately. They punish it eventually. History doesn't repeat itself by it rhymes. The real question isn't whether another crisis will come, it's this. When it comes, will you be positioned to survive or forced to react? Preparation always wins.